Okay, I'm going to go over a fairly complicated capital budgeting problem that I got from this program here called a SEPI. It's a program that I use for my MBA course. You can go to asepi.com, and it's basically auto grades it and helps the students get feedback on their problems, and they seem to like it. This is the first semester I used it. It's $10 for the students, so if you're a professor thinking about something that auto grades Excel, you might want to look into that. It uses several different books. All right, so this is the problem I got out of the book, or out of a SEPI, and I had assigned it to my students, and they were having a little bit of problem, and I understand why, because you have to make some assumptions that aren't necessarily clear in this intro. But anyway, let's just go ahead and, to save time, you can pause the video and read this and see how I set it up over here. I'm not going to explain that. That's pretty simple. You can look at this and see how I set it up. All right, and after you pause the video and kind of look at that, then we can go ahead and proceed. One thing you notice, I always try to put numbers separate from any typing, right? So if I have to click on it later in a formula, I can. So basically, this problem is a multi-step problem, but really in the end, they want you to find the NPV. So I'm just going to go ahead and find the NPV, and then I'll point out along the way which were answers to steps along the way. So to start out with, let's just go ahead and model. I guess what I'll do, I'm just going to go equals this, right? And then bring it across. And then here I'm going to go equals this. And bring it across. And we can go ahead and make the years bold, just know the years. And we can format this as dollars. Now, I usually like to format it as currency, but I like to do it as a special currency. I like to have red. I like this bottom one for some reason, where if it's negative, it's red with parentheses around it. To me, I just like that one, so we'll use that one. And then the next thing we want is the cost of goods sold, our expenses, right? The cost of goods sold and administration expenses and those types of things. And again, here it says it's 70% of sales. So this is pretty easy. You just go equals 70% F4 to make it an absolute reference, and then times whatever the sales are that year. Pretty standard. And then the next thing we want to do is, let me put the formula here as I go. And the next thing we want to do is we want to do the depreciation. Okay, so what Excel's doing is trying to be smart and use what I used up above, but I just want that much. So I want the depreciation. It's actually an expense. I guess we could call it expense. And so we're really not going to start depreciating until the factory is operating. So we'll just call the depreciation is equal to well, it says here it's depreciated straight line over 10 years to $0, right? So we've invested $300 in capital equipment, so we could say it's equal to parentheses this F4 plus this F4 times, well, in 10 years it's going to do 1/10 per year, right? 1 divided by 10. For that. So it's going to be this 300 million over 10 years. If it's a straight line, it's going to depreciate 1/10 of its value per year. So notice I put dollars over this because when I copy this over, I want it to just be the same for everyone. So if I hit enter, it gives me that, and then we can just copy that across. And let me show you the formula again. Okay, so that's the depreciation here. So even though I spent 200 million here and 100 million here, I don't start. So this is what I'm telling you. I might have differed a little bit from the book. I guess maybe the book's more right, but originally when I solved it, I started depreciating the $200 million in this year, and I started depreciating both of them this year. So the number was different here. So I had like a $20 million depreciation here, right? And then it jumped up to 30. But I'm not saying the book is wrong, but sometimes you make different assumptions, and it's going to make your answer wrong. And it's kind of hard to know when you're learning which one. So the book, they decided let's depreciate both of them. That's probably more right because you're not starting to manufacture until this year, right? So that's when they depreciated. So, so the next thing, the factory wasn't complete, right? The factory wasn't complete. They were building it. So they weren't able to, I guess they didn't depreciate it until they finished the building. All right, or the factory. All right, so the next thing we want to do is we can calculate, so I guess let's put in a 0 here. And a 0 here, and again we'll format. Let's kind of format all the way down. That way we don't have to keep changing everything. All right, and then so now we want to calculate the earnings before interest and taxes, and I'm going to go ahead and just underline this just to make it a little bit neater. So it's going to be equal to my sales minus my cost of goods sold minus my depreciation expense. All right. And then the next thing you do, this is pretty standard in whenever you're doing any capital budget analysis, next thing you gotta do is subtract the taxes. I guess I should say less taxes, right? And so my taxes are going to be equal to my EBIT times my tax rate. Of course, F4 the tax rate, so it doesn't move when I copy it across. And then I can underline this. And, well, let me not underline that. Let's just do this in a couple steps. And then we're going to say add back depreciation. And depreciation is just whatever it was up here. Now we can underline all that. And we can call this the operating cash flow. And that's going to be equal to this minus this plus this. Alright. And so along the way, I think this is one of the questions it asks. That's the first part 1 question it asks, what that is. Alright. So far it's pretty straightforward. So the next thing we want to do, we want to calculate, I'm going to indent this a little bit because this isn't part of I'm going to say the book value of the capital equipment. Okay, so the book value of the capital equipment. Well, we know we spent 200 million here, and we spent 100 million here, so that's what it's worth. But then we started depreciating it, didn't we? So really, what you could say the book value of the capital equipment is here it's actually equal to 200 million plus the $100 million we spent here, right? So that's the book value, and then we started depreciating it. So if you depreciate it, it's going to be equal to this minus whatever we depreciated. I guess we could just use this one here as closer. And we can keep, if I did that formula right, it should decrease as we go. So at the end of the book value at the end of 2026 is $180,000, right? And then, so the capital equipment investment would be well, it's going to be equal to, well, again, it's just, the first 2 years is going to be these, right? And then on the book, it went down to here, but then we sold it down here. And remember, on a previous problem I did, another YouTube video, the equation is already there. If you want to calculate the after-tax cash flow, it's going to be equal to the market value minus parentheses the market value minus the book value, right? And then that's going to be times the tax rate, which is 23%. All right. Now the problem is this is how much money we're getting back, right? Because we sold the equipment, and also we sold it for $100 million, and we also got a little bit of our taxes back too, because the book value was 180, so we hadn't depreciated as far as we needed to, so we got a little bit of tax advantage there. That's why it's more than we sold it. But the only problem is this isn't an investment. This is the opposite of an investment. This is how much money we get, right? So it's not an investment. We're getting that money, so we have to make it a negative investment. So I'm going to put this as this, right? So that would be another problem, because this isn't actually an answer the book wants. If you would have put positive there, it might confuse you. So remember, since it's an investment and this is money you're getting, well, then you have to make it negative. It's a negative investment. Hopefully that kind of makes sense, right? Because here's where money's coming out of your pocket. So if money's coming out of your pocket, money coming in your pocket on the same line has to be negative. Maybe it makes more sense that way. All right, so we can do the cash flows after capital equipment. And so all we would do is you go equals the operating cash flow minus the cash flows after a capital equipment, or minus the investments in capital equipment. Now that might make a little bit more sense, because I'm taking this minus a minus makes it a positive, right? All right, and then the next thing we want to do is we need to know the net working capital. So this is going to be something we just have to do along the way here. So I'm going to indent it. Net working capital needed each year. So the net working capital, if you read here, it says 15% of sales. So the first year we need net working capital is 2023, because we don't have sales till then. Now this is another thing. Other books might differ. They might say, well, the net working capital you need in this year, you know, at the beginning of the year, right? So they might shift everything over by one period. But this book does it a little bit different. They do it in the same period. So it's actually easier that way to do it in the same period. So it's going to be equal to the net working capital we need is here's our sales, and you're going to take it times 15%. So you need that much net working capital. Net working capital is saying, whoops, I forgot to F4 that 15%, so it caused me problems because it moved when I copied it across. So this is kind of how much inventory you need in stock in order, inventory, things like that you need in stock in order to run your factory, right? So this is and it says you're going to reduce it to 0 the last year, so I'm going to change that to 0. And let me put the formula. I'll put the formula text for this formula, right? Because I typed in a 0 here, so that won't mean much. Okay. But really, we want the additions to net working capital. We don't want how much is needed. Net working capital is a little bit weird. So this first, I'm going to go ahead and just copy. I'm going to put 0 here, 0 here, 0 here, 0 here, because we don't need any. So this first year, we need 27 million, right? Now the next year, we only need 3510, so it's going to be equal to this. Oh, I'm sorry. additionally we need this minus this. So we'll need eight because we need this, and we already have 27 million in working capital, so we need to only add 810. Now this one is going to be equal to this minus the sum of those two, because now because it's the balance of what I have in there. I added 27, I added that, so subtract the sum of those two, right? And then finally, you have to give it all back at this last year, so it's going to be equal to a minus sum. So you're going to get all that money back, right? Your net working capital is going to go down to 0. So it's going to be 4212. And I think that's another answer they ask along the way. Okay. Hopefully that kind of makes sense. Net working capital is a little bit weird. You have to be careful. You don't want to calculate the balance, but you want to calculate the addition to it. So if it went from 27 to 35, it went up 810. Well, now the balance is 35. I guess I could have done it. Maybe I should have done it. Let me do it in a way that's a little bit easier to understand. This would be this one. Maybe you could do it like this. It's equal to this minus this. See if that works better. But then the last one is just going to be equal to a negative that. No, that didn't work. I'm going to go Control Z. The way I did it originally, I guess is the best way to do it. I was trying to do it a quicker way. So anyway, just do it the way I showed you the first time. All right. And then finally, we can calculate the net present value. Or not the net present value. We can calculate our project cash flows. And our project cash flows are going to be equal to this minus this, right? So we invested 200 million and we invested 100. That makes sense because nothing else really happened those first 2 years. Then we had sales going on the first year, so we have a lot of stuff going on there, and we just keep dragging it all the way across. So this is my investment, and these are my returns for that investment. Okay, so that's pretty easy. And net present value, you should have that down by now too. It's just going to be equal to net present value. The rate is 14%, and since this is a year later, you have to include that. Net present value starts with year 1, right? So this is our year 1, and it doesn't start. You add this in outside of it, right? So, and then you're just going to add in this initial investment on year 0, and oops, you have to add that outside of the NPV. So my NPV is a negative 73 million. So what is that telling you? Should I do this project or not? This is telling you this would not be profitable, right? You'd lose $73 million. So anyway, so that's another thing we could do. I'm going to go beyond the book a little bit. Another thing we could do is the internal rate of return, right? We can go equals IRR, and that way you do all of them, and that's 6%. And you can compare that internal rate of return to how much we cost to borrow our money, and it costs 14% of our borrow money. The project only made 5.9%. So that also would tell you don't do the project, right? So that's kind of a bonus. All right, so anyway, hopefully that was interesting. My picture will come up. If you like this video, subscribe by clicking on my picture. Give me a thumbs up. That always encourages me to make more videos. And make sure you make some comments if there's something I forgot to say or something that was interesting. As you can see, I think I highlighted, this was another answer they wanted right here, the project cash flows. So so there's the thing, those areas you could, not really clear, right? Like when do I start adding, when do I need my net working capital? Like I said, I originally did the problem when I did it before looking at the book. I shifted this over, right? And I originally started depreciating. So So sometimes you can make some assumptions that can really confuse you because, you might say, well, how do I know they want that to be negative, right? Because it is a salvage value is positive, right? So why do we want to put negative in here? But the book wants negative. So those things can be stumbling blocks when you're learning. But anyway, hopefully that was helpful. And I'll see you next time.